picture this. You're sitting at your desk, right? Just staring at your trading screens.
Oh, yeah, we've all been there.
Exactly. And you're holding an Apple 200 strike call just 2 days before their earnings report.
Yeah.
You are absolutely sweating every single price tick. Or, maybe you're on the other side.
Right, like looking at selling SPY puts during a massive VIX spike.
Yeah, trying to step in and capitalize on all that widespread market panic. And those are high-drama, high-stress situations. The adrenaline is pumping, but the variables are basically impossible to control.
Totally. It's a gamble at that point.
So let's strip away the earnings drama and the macro panic for a second. Let's look at the purest, most fundamental setup in technical trading.
Okay, I like where this is going.
A stock you've been watching is sitting right at $100 a share. It is knocked against this $100 level 3 times in the past month, and every single time it gets rejected. But today is different. It's pushing hard. So you go ahead and pull the trigger. You buy the $102 strike call option expiring in 30 days, and you pay exactly $3 for it.
And that is when the clock instantly starts ticking. Like the moment that order fills, the psychological game begins.
Oh, for sure.
Because the question that haunts literally every trader going long in that scenario is, did they just buy the start of a massive portfolio-making rally?
Right.
Or did they just step blindly into a trap that's going to completely crush their premium by Friday?
So that's the mission for this deep dive. Did you buy the rally or step into a trap? And the difference between those two outcomes, it isn't luck. It's in the math, the volume triggers, and avoiding those fake outs.
Yeah, the fake outs that look like genuine breakouts.
Exactly. So let's break down exactly how the institutions are trading these levels from the sources we've got. We're going to examine the whole life cycle of this trade, from the payoff at expiration to the exact break-even math to how different tickers behave when they hit these critical levels.
We really need to start with the mechanics of the level itself, though, because when a stock is repeatedly hitting a level like $100, I always tell traders to picture that price ceiling like a heavy locked oak door.
Okay, a locked oak door.
Right. And the buyers in the market are holding a battering ram. So every time the price pushes up against that level, the battering ram is just slamming into the door. The door might splinter a little bit, which is the price testing the level, maybe touching 99.90, but the door ultimately holds.
I see where this is going. The battering ram itself isn't what breaks the door down. It's the force behind it.
Force is everything. And in the market, force is volume. Volume is simply, the number of people holding that battering ram.
Right. Yep.
If you have 2 traders tapping a heavy oak door with a piece of wood, the door isn't going to budge. A massive institution sitting on the other side with limit sell orders is going to absorb that pressure instantly.
But if you have 200 guys sprinting at that door with a massive ram...
Exactly. The door is coming off its hinges, the sellers get totally overwhelmed, they pull their orders, and the price surges forward.
Hold on. I'm stuck on something here. Let me push back on this on behalf of the listener.
Sure, go ahead.
If the stock broke the $200 level, it broke the level. The chart shows the line was crossed. Why on earth does it matter how many shares changed hands if the price actually went up? Like, a break is a break.
Yeah.
The door opened.
It appeared to open. But let's look at the plumbing of the market to understand why this is often an illusion. Look at the historical data for the Coinbase trade ticker symbol COIN.
Oh yeah, the COIN trade.
It's a textbook example of this exact illusion. So Coinbase was testing a massive historical level at $200. It finally ticked above it.
Right.
And traders saw the price hit $202. They just rushed in to buy calls expecting a massive continuation, but the underlying mechanics were rotten. The break happened on below average volume.
So there's basically no battering ram.
There was barely a knock. What actually happened in the order book was just a temporary vacuum of liquidity. There weren't a lot of buyers, but there just happened to be 0 sellers at that specific moment.
Oh, yeah.
Yeah. A tiny amount of buying pressure pushed the price up simply because the resistance wasn't there to absorb it. It was not a tidal wave of new buyers. And without volume confirmation, which we want to see at 50% or more above the average daily volume, there's no real institutional momentum.
So it's essentially a fake out. Just a bear trap covered in leaves.
The data shows the brutal reality of these traps, man. Because the move lacked real momentum, the moment actual sellers stepped back into the market, there were no buyers left to hold the line.
Right, they were exhausted.
Exactly. The buyers exhausted themselves on that tiny push. Within 2 days, Coinbase dropped all the way back down to $200 and plummeted to $160.
Ouch.
Yeah, anyone who bought breakout calls was completely wiped out. The lack of volume was the flashing red warning light that the breakout was completely hollow.
Okay, so let's assume we do get the volume. The door flies off the hinges, volume is soaring 50% above average, and we have a valid breakout.
Okay, great.
Paying $3 for a call option sounds simple enough, but options are notoriously tricky. How do we structure the trade to actually capitalize on the momentum without getting chopped up by the contract mechanics?
Let's run the exact math on that initial setup. The stock breaks $100 with massive volume. The standard approach is buying at the money calls.
Right.
So the stock is at 100, you buy the $102 strike call option, and importantly, you buy it with 30 to 45 days to expiration.
I always hear about that 30 to 45-day window, but honestly, it feels kind of arbitrary. If the breakout is happening today, why am I paying for 45 days of time?
Okay, so we have to define a Greek pricing term here called theta, which measures time decay. Think of theta like an ice cube sitting on your kitchen counter.
That's a cube.
Yeah, if you buy an option expiring tomorrow, that ice cube is sitting directly under a heat lamp. It melts aggressively. Every hour the stock doesn't move, your option loses significant value.
Oh, that makes sense.
But if you buy 30 to 45 days out, that ice cube is sitting in a cooler. It's still melting, right? Time decay is always happening, but it's melting slowly enough that you have time for the technical pattern to actually play out.
Ah.
You're basically buying a buffer.
Okay, that buffer cost me $3 in premium, though. Let's walk through the actual break-even math so we know exactly what we need this stock to do.
Finding your true break-even at expiration is completely linear. You take the strike price of your contract, which is $102, and you just add the premium you paid, which is $3.
So 105.
Exactly. 102 plus 3 is $105.
That means the stock has to rally a full 5%, from 100 to 105 by expiration day, just for me to get my initial $3 back.
That's the hurdle rate. But let's look at the payoff scenario if the volume confirmation was real. Say the stock runs to $115 over the next 3 weeks.
Huge move.
Right. Your contract gives you the right to buy the stock at 102. With the open market trading at 115, your call option has a pure intrinsic value of $13.
Wow. And since my initial outlay was only $3.
You're looking at a 330% return.
But wait, paying $3 for a call on a relatively boring stock is one thing. If I try to buy an at-the-money call on, like, a super hyped AI stock, the premium is going to bleed me dry.
Oh, absolutely.
I've seen premiums of 10, 15, even $20 for a 30-day contract. How do I trade a breakout when the entry cost is already priced for absolute perfection?
High hype means extreme option prices, and that requires a structural pivot. If buying a single call requires way too much capital and pushes your break-even to some unreasonable level, you create a call-debit spread.
A call-debit spread.
Yeah. You buy the at-the-money call, but you simultaneously sell a further out-of-the-money call against it to subsidize your own cost.
Selling an option to buy an option. That feels like it needs a translation for me.
Think of it like a VIP concert ticket. Imagine your favorite band is coming to town. A VIP front row ticket costs $500.
Way too expensive for my budget.
Exactly. But that VIP ticket happens to come with a backstage pass that you don't really care about. So you buy the $500 VIP ticket and you instantly turn around and sell the backstage pass to someone else for $200.
Oh, I like this.
Right. Your net out-of-pocket cost is now only $300. You still get to sit in the front row and enjoy the concert. The only trade-off is that you gave away the absolute highest tier upside.
I love that analogy. I get the core experience, but I let someone else pay for the extreme tail end of the event. Let's apply that concert ticket to the $100 breakout.
Okay, so you want to participate in the move. So you buy the $100 call. That's your VIP ticket. Let's say the market is pricing it at a hefty $5.
Okay.
Simultaneously, you look further up the option chain and you sell the $110 call for $2. That's selling the backstage pass to another trader who's hoping for a massive, unrealistic moonshot.
And I collect their $2 immediately.
Exactly. So your net cost drops from $5 to just $3.
My risk is strictly capped at that $3 too. If the fake out happens and the stock drops back to 90, I don't lose $5, I only lose the 3.
Your risk is minimized, yeah. But we also have to look at the ceiling. Because you sold that $110 call, your profit is absolutely capped at $110.
Even if it moons.
Even if it moons. If the stock goes to $1,000, it doesn't matter. You are obligated to sell at $110. So 110 minus your $100 strike creates a maximum spread value of $10.
Got it.
Subtract your $3 initial cost, and your max profit is perfectly capped at $7.
A $3 risk to make $7.
Yeah.
I mean, that is incredibly efficient for a market that's pricing in way too much hype.
And that actually brings up a critical point about the underlying stocks themselves.
Yeah.
You can't trade a sleepy utility stock the exact same way you trade a tech giant. The narrative surrounding the ticker completely changes the architecture of the setup.
The narrative is what creates the volume. Like when you look at the historical analysis of NVIDIA ticker NVDA during its massive run, you see how narrative basically drives the geometry of the chart.
Yeah.
NVIDIA formed a massive consolidation pattern right at the $500 level.
On a chart, for those listening, this specific setup looks like a dip that rounds out, rallies back to resistance, and then pulls back slightly into a tight range before exploding, like a cup and handle. The historical success rate on this pattern is incredibly high. And the why behind that pattern is fascinating, because the artificial intelligence narrative behind NVIDIA was so dominant that final pullback, the handle was exceptionally tight. It was only a 5% range.
That's tiny for NVIDIA.
Very tiny. What that tells us fundamentally is that supply had completely dried up. Every single person who wanted to take profits at $500 had already done so. The sellers were exhausted.
So when it finally pushed above 500,
It shattered the level on 3 times its normal volume. It ran from $500 to $800 in just 6 weeks. The at-the-money calls tripled in value almost immediately.
okay, I hear that, and my immediate reaction is just frustration.
Why is that?
Well, if I'm looking at a chart and I see a beautiful consolidation forming with dried up supply, and I know the historical success rate is solid, why am I waiting for the breakout?
Hey.
Why wait for the door to break?
Yeah.
Shouldn't I just buy my calls while the stock is sitting quietly in that tight 5% range to save money?
Buying while the stock is still in its consolidation base is definitely an advanced approach, but it exploits a massive inefficiency in how options are priced. It all comes down to a concept called implied volatility.
Right.
When a stock is consolidating tightly, it's barely moving. So to an algorithmic pricing model, the stock is boring. And because it's boring, implied volatility drops off a cliff. When implied volatility is low, option premiums are incredibly cheap.
I always hear about implied volatility, but it honestly just sounds like math jargon designed to confuse retail traders.
Yeah.
Why does a boring stock make the option cheaper? I need an analogy here.
Okay, let's put it in the context of buying an umbrella. Buying options before the breakout is like buying an umbrella on a perfectly sunny, cloudless day.
Okay, no one needs an umbrella.
Right. The merchant selling them is practically giving them away because there is zero demand and zero perceived risk of rain. But once the breakout happens,
The clouds roll in.
instantly, and it starts pouring, suddenly everyone in the market wants an umbrella. So the market maker skyrockets the price of the umbrellas to compensate for the massive demand and the newly realized risk.
So when the breakout happens, implied volatility just expands rapidly.
Drastically. By buying pre-breakout, you're capturing a dual-engine return. You profit intrinsically from the stock moving from $500 to $600, but you also profit extrinsically because the market maker is drastically marking up the price of your umbrella due to the volatility spike.
The option itself becomes inherently more valuable just because the stock is moving fast.
Exactly.
That sounds like a cheat code. Why doesn't everyone just buy before the breakout?
Because of the massive directional timing risk. What if it never rains?
You're stuck holding a useless umbrella.
And going back to our earlier point, you're holding an umbrella made of ice.
Oh, the theta decay.
Yes. The risk is that the technical pattern might fail to complete. The stock might just sit in that tight 5% range for another 2 months. If you bought 30-day options, the theta decay is eating your premium every single day while the stock does absolutely nothing.
You've tied up capital in a dead asset.
Precisely.
Timing really is everything. Okay, so let's fast forward. Say we timed it right. We demanded volume, the door is down, and we are actively in the trade. The stock is running. But we know traps exist.
Like you.
How do we manage the trade minute by minute to make sure we don't fall victim to a reversal after we're already holding the bag?
Intraday trade management requires looking at the exact same indicator that the largest institutions in the world use to manage their own risk, VWAP, the volume-weighted average price.
See, whenever a technical term includes the phrase weighted average, it usually means the math is complicated, but the concept is simple. Break down what VWAP actually represents on the screen, like in the real world.
Think of VWAP as the absolute center line in a massive tug of war between the buyers and the sellers throughout the trading day.
A tug of war.
Yeah, because it factors in volume, it shows you where the majority of the money is actually flowing. If the price is pulling above that center line, the buyers are winning the tug of war. If the price is dragging below it, the sellers are overpowering the market. It's a dynamic moving average that resets every single morning.
Why do institutions care about a daily tug of war, though? Don't they have a much longer time horizon?
They do, but their execution desks are graded on VWAP. When a mutual fund needs to accumulate 2 million shares of a stock breaking out, they can't execute a single market order.
Right, they'd spike the price.
Violently, they'd ruin their own entry price. So they use algorithms to slice that order into thousands of tiny pieces, executing slowly throughout the day. The execution trader's performance bonus is literally determined by whether they manage to buy those shares at or below the VWAP line.
They're trying to prove they got a better than average price for the volume traded.
Exactly.
So the line matters because the people with the deepest pockets are using it as their own personal benchmark. It's almost a self-fulfilling prophecy.
It really is. It acts as dynamic support and resistance. Knowing this, the management strategy for our breakout trade becomes incredibly systematic.
Okay, walk me through it.
When the stock breaks out, you do not buy your entire position at once. You scale in. You buy 50% of your desired position on the initial volume surge. Then you wait.
You wait for what? The pullback.
You wait to see how the institutions react. If the stock pulls back to the VWAP line and you see massive buying pressure step in to defend that line, you know the institutions are accumulating. The tug of war is being won by the buyers.
And that is your signal to add the remaining 50% of your position.
Yes.
That keeps some powder dry and confirms the trend. But how do we get paid? Like, when do we actually sell?
The historical modeling points to taking 50% of your profits at a 1x risk distance. Let's translate that. If you risk $3 on the option premium, once the option goes up by $3 to a value of 6, you sell half of your position.
Which means you've completely covered your initial capital outlay.
You're officially playing with house money at that point. Now, for the remaining 50% of your position, you use VWAP as your dynamic trailing stop.
Okay.
As long as the stock stays above that tug-of-war center line, you do nothing. You let the trend ride, you let the buyers keep pulling the rope. But if the price breaks below VWAP, and especially if it breaks below with heavy volume,
The tug of war is over.
the institutional support has evaporated, the execution desks are done buying, so you exit the remainder of your position immediately. You do not hold and hope.
Man, let's pull all of these mechanics together then. First, you're waiting patiently for the setup, watching that stock hit its head against the ceiling. Second, you're demanding heavy volume confirmation, because without it, you're stepping into a liquidity trap.
Exactly.
Third, you are matching your option strategy to the environment. If premiums are cheap, you grab at-the-money calls. If the hype has made them expensive, you use call debit spreads, selling that backstage pass to manage your break fins and strictly define your risk.
Perfect summary.
And finally, you are letting the institutional benchmark of VWAP guide your entries and exits to protect you from those intraday reversals.
It's really all about removing emotion from the equation and trading the actual mechanics of supply and demand.
Which brings us to the definitive takeaway. If you remember only one thing we've explored today, make it this. A technical breakout without volume confirmation is just a trap waiting to spring. So use spreads to manage your risk and let VWAP guide your exits.
That is the mechanical reality of the trade. But I actually want to leave you with a final thought to mull over as you watch these levels on your own screens.
Let's hear it.
When a breakout is genuinely successful, the old resistance ceiling historically becomes the new support floor. But think about the underlying psychology driving that dynamic. When the price dips back down to retest that old $100 level, who exactly is providing the buying pressure at that new floor?
Oh, that's a good question.
Right. Is it simply the sideline traders who missed the initial move, finally getting their chance to enter? Or is it the terrified short sellers, the ones who bet against the breakout, desperately buying shares to cover their tracks and exit their losing positions before they're completely wiped out?
Definitely something to keep in mind next time you watch a chart test that magical line. Thanks for joining us on this deep dive. See you next time.